So I will implore you, if you have any question, please, or don't hold back. Always try as much as possible to ask your question, and that when you feel free. Okay, so let me go through the rules before we move on to today's class. Now, the first rule says that students are muted on both audio and video. This is to allow for proper coordination of virtual lectures. So this means that you will not be allowed to unmute yourself both from your audio and video. But what you'll be done is that what will be allowed is when you have any question, you can easily use the chat button to ask the question. So let's go to the second one. Second one says that students are allowed to use the chat button to ask questions. In case of the technical difficulty for student N, kindly call our helpline, and we have the number there. Kindly call our helpline, which is 09036 or send the chat via SMS platform. It means that we have any challenges that you need us to attend to, please try as much as possible to reach us through our helpline, or you can use the WhatsApp group that was created for you. So the WhatsApp group was created for you. You can easily use that medium to pass through your grievances or anything you tend to do. Okay. Now the third one that we have there says that the third one that we have there, it says students are expected to coordinate professional when using the chat button to ask questions or express their concern. What this is saying that you should try as much as possible to be professional when you are asking your question. Try as much as possible to use kind words and words that are actually what welcome, that are encouraging for to ask your question. So it means that both from the lecturer side, as much as we are trying as much as possible to give you your due respect, also you also in your asking question or pointing out your concerns, you should also try as much as possible to be modest in it. So another one also that we have is that we have the student are advised to listen attentively during lecture rather than writing, since lecture material would have been provided ahead of each classes. Although key points that might aid understanding might be jotted down. So what is this saying? That in order for you to take best, in order for you to enjoy this class to the fullest, try as much as possible not to focus too much on writing, because when you focus too much on writing things down, you might actually lose some under explanation. When it comes to some explanation, you might miss out, and the explanation might be key. So it's advisable that you try as much as possible not to write too much down. But anytime you have a place that you need to jot, if you notice that you need to jot one or two things down, then it's advisable for you to go ahead and jot what you need to jot down. Okay, because you have the question, you have the answer. But what you need most is the explanation. So if you get the explanation, then you are good to go. Another one that we have here, it says that all questions will be attended to after the lectures. This is ensure effective time management and smooth running of lectures. So we are expected to answer your question at the end of the lecture, but because of the flexibility, we have a little bit, we have let these rules to be flexible for the lecturer. It means that there are times that I will ask you for a question, or there are times that I will pause and go on to your chat, the chat message, pause to look at if there's any question pending there. So it's not compulsory that I actually wait to the end of the class to answer your question. So when the lecture is going on, you can easily use the chat button and communicate your question to the lecturer. Then we have the last one says that feel free to call or chat your lecturer for questions and clarification outside the normal lecture time. So you can get my number from the group chat, the WhatsApp chat that was created. Material was sent there today. At the same time, also you can easily write my number down. That's 070 36 64 9283. Okay, so if I'll repeat that once more. So you can just write it down and save my name. And if you have any question, you can call me or chat with me, WhatsApp chat. Then I will what? I will be obliged. I'll be responsible. I'm the what expected to reply you, and I will surely reply you. So my phone number again, which is my WhatsApp number, is 070 36 64 9283. Okay. After that being said, so let's go on to the business of the day. You know, basically, this lecture is all about basically is revision class. It means that we are going to have questions and we're going to have solutions. So what we'll be doing is we talk about one question, we talk about solutions, and we address it and we treat it and we move on to the next. So in point or in course of answering those questions, there is place that my explanation will be needed. And if that explanation is needed, I will try as much as possible to brief the topic, and then I will attend to any cogent area that you expect to, because in your examination, you have objectives and you have theory. So when I'm explaining, and in my explanation, please, you need to pay attention so that you'll be able to get when I'm explaining things that can come out in your objectives, because your objective also is 20 marks and it's as important as your theory. So today we're looking at question one. This question one is pick point from a particular topic, which is the double entry. Double entry. So we are double entry principles. So before we move on to the double entry principles, I want to do a little recap on financial accounting. I just want to do an introduction to financial accounting. Then I will move into the double entry principle. Now, what do you understand by financial accounting? Financial accounting is actually the process of preparing the financial statement. It's all about the how financial statements are being prepared, how financial informations, financial transactions are being recorded, how financial transactions are being recorded in the financial statement. Now, what is financial statement? Financial statement is actually it comprises of financial transactions that occurred within a particular period of time. That's financial statement. So it contains financial transaction that occurs within a particular period of time. So financial statement comprises of various statements, and its example of them are, we have the statement of financial position, which is formerly known as balance sheet. We have the statement of financial performance, which is formerly known as profit and loss accounts. We also have statement of cash flow. We also have accounting policy. We also have notes to the account. Then we now have we have others information that will be regarded that makes up the financial statement. Example of other documents or statements or reports that can be attached to financial statement is number one, director's report. Number two, responsibility report. Number three, environmental report, and the likes. These are the other examples of reports that can be attached to financial statement. But note, it is mandatory, according to IS1, that these 5 statements that I've actually mentioned before must be present in the financial statement. And this is one. I'm talking about the statement of financial position. Secondly, I'm talking about the statement of financial performance. Thirdly, I'm talking about statement of cash flow. The fourth one is the statement, note to the account, and also we have the accounting policies. These are what is expected of you to have. So then another thing that you need to know is that there's what we call accounting process. Accounting process means how we start from the end, the start to the end. That's the accounting process. And you need to know this accounting process because it will guide you to know how these financial statements are being prepared. It is very, very, very important that you know it. Now, when you talk about financial statement, we said that financial statement is actually a statement that shows the financial transaction. So what we are saying is that we have a lot of financial transactions that happen that leads to what? That increase and or decrease in economical benefits for the organization. So now when we are talking about that, we have a lot of documents that we will need to organize, we need to collect and organize in order for us to make meaningful sense out of it. So the first step under the accounting process is the collection and analysis of financial transaction. It means that you must first of all have the information before you can proceed to the second step. So the first step, before you can prepare any financial statement at all, is to have to analyze as well and record the financial transaction. An example of financial transaction are number one, the sales of inventory. The receipt or the waybill or the receipt or the invoice that is used can help to record that down, because every financial transaction must have a backup document, which is regarded as source document. So example of source document are all these invoice, receipt, check stub, or another one we have the PO, purchase order, and the likes. These are the example of document that it is required that must back up your financial transaction. It means that none of regular transaction can be recorded into your statement unless it is it will have backup. It have a document to show for it, which means it discourages what you know as dry posting. Then after that, you now move to the second step. And the second step now means posting into journals. You raise journals one after the other, then you post into journals. Journals are the primary book of accounts. They are the first records that you use to show how the financial transaction affects the two accounts. That's the journal. So if you look at the table of journal, under the journal we have dates, we have the particular, we have the debit and the credit. Then after we have the journal, the next one is not for us to post into ledger. And ledger is the permanent book of record. It is one that we pick information from journal to post into ledger. And ledger means that for example, now if you have journal, you just list various information inside journal. For you to know your total cash balance at the point in time on journal is not possible, because each transaction are being recorded as they occur. But in ledger means that you classify the expenses or the revenue that have the same attribute under a particular head. For example, we have cash accounts, which is also a cash account, which is ledger. It means that every cash transaction can be found under that account. So at a point in time or at any particular point, we can establish the balance of such cash ledger. Then after we have derived the ledger, we now move to the trial balance. Trial balance is the statement that show the accuracy of the balancing in the ledger. It means that everything that we have posted into the ledger, the balance figure will be taken and be put under the trial balance. The trial balance just have the particulars, the date, the debit and the credit. So it helps if the debit and the credit does not balance, it means that the ledger or what we have done, what we have posted in the ledger is wrong. Then we need to We need to check it out. So that will give and that topic that we talk about the suspense account. It means that when your trial balance refuses to balance, then it means that you need to troubleshoot it. So we have two types of errors. We have errors that affect trial balance and errors that does not affect trial balance. Then after you have prepared your trial balance, the next step is for you to now do adjusted trial balance. What do you understand by adjusted trial balance? Now, adjusted trial balance is as a result of you adjusting the initial trial balance that you have developed. We have some transactions that we normally carry out at the end of the month or at the end of the year. Example of them are depreciation. Depreciation is not always carried out during the year. It's actually carried out at the end of the month, or rather at the end of the year. Another one also is what is the accrual basis. The accrual expenditure. This is also another one that we use to adjust our trial balance. Another reason also we have is also the closing stock, the closing inventory. It's another adjustment on our what? On our trial balance. So this adjustment, bad debt, provision of bad debt is another example because it's used to reduce our receivables account. So it's another example of what? Adjustment on trial balance. Now, once you have adjusted your trial balance, that your adjustment trial balance is regarded to your final trial balance, because it's from that your adjusted trial balance, we now move to the next step, which is preparation of financial statement. You now do the preparation of the financial statement. Now, when you prepare the financial statement, it means that the figures from your adjusted trial balance is what you are going to carry over to your financial statement. Then you now prepare the statement of financial position, prepare the statement of financial performance, then you prepare the statement of cash flow. Then after that, you now have your closing trial balance. Your closing trial balance contains your assets, your liability, and your equity, because these are the balance that can be carried over to the following accounting year. Now, financial statements can be prepared in what? In what it can be prepared within 12 months, and that 12 months are regarded as a reporting year. Reporting year, accounting year, or financial year. So anytime you hear the reporting year, accounting year, financial year, they are regarded to the 12 months in which the financial statements are being prepared. It is not compulsory as in the private sector for your financial account to start from January to December. It can be from June to what? To June, from June to May. But what is compulsory is that it must be what? 12 months. The reporting period must be 12 months. Now, once you have done with that and you are good to go, then the next thing that you need to know is for you to understand the basis in which we prepare the financial statement. In your financial accounting, we have three bases to prepare the financial statement. We have number one, we have the cash basis. Number two, we have the accrual basis. And number three, we have the break-up basis. Cash basis is used to record financial transaction in the financial statement whenever revenue are what? Received, and whenever expenditure are paid. It means that no transaction should be recorded in your financial statement except there is movement of cash, either inward or outward of movement of cash. That is cash basis. Then we have accrual basis. Accrual basis is used to record financial statement in the financial transaction in the financial statement when revenue are earned and when expenditure are incurred. When revenue are earned is that we are referring to that you have incurred, you have earned the revenue, but you are yet to receive the money. It means that when you make sales on credit, you have what? That money you have actually, you have made sales like a revenue to you, but you have not collected the money. But you are going to record it in our financial statement, because we are using what? Accrual basis. It means you have earned it, but you are yet to receive it. And that's giving rise to what? To the trade receivables. Trade receivables is also formerly known as the debtors. So, but right now, it's no longer referred to as debtors, but it's now referred to as trade receivables. Then for the expenditure aspect also, I said expenditure is incurred, not when it is paid. It means that whenever you have enjoyed a particular benefit and you are yet to pay for it, it means you are still going to pay for it, and that gives a rise to what we call liability. It's because you are still going to pay for that benefit or what, or that particular thing that you have enjoyed, but you have to record it in your financial statement that this is the cost that you have incurred, because it goes in line with what we call the matching concept. Then the last one is the breakup basis. The breakup basis is the one that is used to record financial transaction whenever the going concern of the organization is in question. It means that when it has been foreseen that the organization or the company will no longer be existent in the next period or in the next few months, then it means that financial statement should be prepared using the breakup basis. That means that the cash and accrual basis are used to record transactions for going concern companies. It means that companies that are what have regarded that will be in existence for next foreseeable years or months. That which means there's no, we are yet to set their dead point, their own point that they actually what they will close up. Okay. After that being said, another thing also that you need also to know is that there are some concepts, there are some rules, there are some conventions in which we prepare our financial statement. Example of them, of the word of this concept are: number one, historical concept. It means that financial transactions recorded in the financial statement are historical. They are sunk cost. It means we have incurred, it has been carried out in the past. Financial statement is used to report what have been carried out in the past. And the other one is going concern concept. Going concern means that the financial statement will be prepared as what? As if the company will continually be in existence for next foreseeable years. Then we have another one as well, which is the what we call the monetary concept. It means that any financial statement that will be found or be posted into the financial statement must be able to be quantified in monetary aspects, must be able to be quantified in the monetary term, which means if you cannot attach a value to it, it will not be found in our financial statement. We also have matching concept. Matching concept is all about trying as much as possible to match the relevant expenditure to the revenue. It means if I incur a revenue of 1 million now, the associated expenditure that I have incurred for me to derive that revenue should be matched against the revenue to get my profits. Then we have the prudency concept as well, who says that ascertain what? Ascertain no profit or ascertain no gain, but make provision for all losses. It means that what the revenue that you have not get, don't record it as if you have gotten it. For example, if someone promised you that they will come and buy something, it's not, you are not expected to incur it. You are not expected to record it that you have made that sales because that person has not committed any amount to it. Then another one also, when it comes about make provision for it, is that when you know that probably there's a litigation against the organization, and based on the experience of the lawyer, they ask you for the way this thing is going, it's possible that we might be liable for a particular sum of amount. Then it means that what? It means that we are expected to make provision, even though we are yet to pay for that money, but we make provision for it because it occurred during the accounting period or accounting year, reporting year. So we have to make provision for it. And we have the lex like that. We have other one like that. We have the entity consent, which means that what? The owner, there should be a separation between the ownership and the what? And the business. Which means if I'm running an organization, my company should be able to stand on its own, and also I will be able to stand my own, which means my company can be sued or sue other organization or other person. Now, after that being said, another thing I want to call your attention to is the accounting equation. Accounting equation is actually very, very important as a financial accountant, accounting student, for you to know. Financial equation talks about the relationship, or it summarizes the financial statement. It summarizes the financial statement. And what is the accounting equation that we are talking about? We are talking about the assets. equals liability plus equity. Asset equals liability plus equity. Now, before I move on from that, I would like to explain a particular thing, which is the element of financial statement. If you pick up a financial statement, you will see financial transaction there. But these financial transactions have been grouped into elements. And we have them to be what? They have been grouped into 5. And that is number 1, revenue. Number 2, expenditure. Number 3, assets. Number 4, liability. Number 5, equity. These are the 5 elements that we have in the financial statement. What we understand by assets. Assets are resources controlled by an entity as a result of what? Past events in which there will be inflow of economic benefits to the organization. The breakdown of this definition of asset is very, very important. It means that it's as a what? It's the resources that I control. It means I can stop other person from enjoying the benefit from that particular asset. Then I can classify that an asset in my record. At the same time as well, it said that what? It was as a result of past events. It means I've done something in the past for me to be able to claim owed, or to be laid old claim on what? On that asset. An example of it is that I've made, if I purchase a motor vehicle, for the contract that we fill, the money that I've paid to you as what? Either is as a result of past events, which means now I can claim it because the past event that have happened is me buying it from you and me transferring some particular fund of money to you. Then at the same time, it is expected that there will be inflow of economic benefit from that asset, from that resources to the economy, right, to the entity. It means that any asset I purchase with my money or my any resources, or probably because of an agreement, probably because of what, exchange a gift due to our past relationship, then it means that what? That thing must bring in, there must be inflow of economic resources to the organization that owns it. Then we have 2 types of assets. We have the non-current assets and we have the current assets. What do you understand by non-current assets? Non-current assets are the assets that will be in place or are longer years. They are the assets that have 2 years and above. These are the assets that after the reporting date, in the next 12 months, the asset will still be in your financial statement. That's non-current asset. Example, even non-current asset, we have 2 types of non-current asset. We have the tangible and intangible non-current asset. Okay, example of non-current assets. We have number 1, we have the motor vehicle, we have land, we have building, we have plants, property and equipment. We have copyright, we have patent, and we have sales, and so on and so forth. Therefore, current assets are resources that are easily convertible to cash within a short period of time. They are resources that after the reporting date, they are expected to be convertible with cash in the next 12 months. It means that if I close my financial statement as of December, before the next December, that asset will no longer be in my record. It will have been converted to cash. Example is like inventory. Inventory are stock that we owe for what? Pending we dispose it out for sales. It means that if I close my financial year in December, in the next 12 months, that inventory, I'm expected to have sold that inventory and convert it to cash. Another one also is trade receivables, which means I'm expecting money from a particular set of people. But before the 12 months, before I prepare another financial statement, I will have collected the so amount of money that is due to me. Then we have others, so we have the rest as well. So that's the definition of current assets. Then now let's move to liability. Liability is actually defined as a present obligation as a result of what? Past events, in which the settlement will lead to an outflow of economic resources of the entity that embodies it. What you're talking about is that is a present obligation, is present. It's not as a result of past, it's present obligation, which means you are still going to pay is like a debt that you have incurred that presently you are still owing. It's not the future one, it's not what is the present one that you are owing. Then why are you owing it? Because of past events that have happened. Example, at the end of the month, you expect to pay people salary, but you have not paid them salary, but that salary is due. That is, so in the next month, you have not paid, that salary is liability because you have enjoyed the benefit from your staff as at last month. Though you have not paid for it, but it's a present obligation because it's money that you are owing to your staff, and as a result of the benefit that you have enjoyed from your staff, and which the settlement will lead to an outflow of economic resources. And the outflow of economic resources that we are talking about is what? Is your fund that you will now use to pay them. So also another one, so we have trade creditors as well. So liability also is divided into two. We have the long-term, we have the non-current liability, we have the current liability. And this also follows suit with the definition of the assets. The long current liabilities are the ones that will stay in our financial statement after 12 months. After the 12 months after we have reported or prepared our financial statement, they will still be existent even after 12 months that we prepared our financial statement. But the current liabilities are the ones that will be settled within the next 12 months after we have prepared our financial statement. So these are very key that you need to know. Then another thing also that you need to know is this: revenue. Revenue are actually what we call is an increase in the net assets or decrease in the what? Liability. Apart from money contributed by the owners of the company. Revenue is an increase. Revenue is an increase in what? In net assets, or decrease in what? In liabilities, apart from the owner's contribution. Any amount that flows into the organization that increases the net assets or decreases the liability, apart from the contribution from the ownership, is regarded as revenue. Then the opposite side talks about the expenses or expenditure. These are what? These are the outflow of economical resources that leads to reduction in the net asset and increase in liability, apart from the takeouts by the ownership, apart from the payouts to the ownership. It means that apart from dividends that the ownership collected, that the owners collected, or apart from the joins that the owners collected, the rest are regarded to what? As the expenditure. Then we have the equity. Equity is the net residual interest of the asset. Is the net residual interest of the asset. It means that after you have removed assets away from the liability, the remaining balance is what we regard as what? As the equity. It means is the shares of the interest of the owner in the business. Is the interest of the owner in the business. Now, after I've said that, then I believe that you can now pinpoint that the accounting equation is now very, very important. Accounting equation is very, very important. And the accounting equation, like I said, is asset equals equity plus liability. Asset equals equity plus liability. Now, let's move on. There's what we call double entry principles. And this is what? This is key to your success in financial accounting. Double entry principle is key to your success in financial accounting, because everything that we'll be doing, most of it, if not all, surround these rules of double entry. Now, the rules talks about that the general one that we all know says whenever there's an increase, whenever there's a debit entry, there must be a corresponding credit entry. And it says that debit the receiver and credit the giver. That's the golden rule of financial accounting. Now, I will explain it in this way. I've listed out the elements of financial statements. So I'm going to go on to pick each financial statement or the element of financial statement and explain how they are being treated as regards to the double entry principle. So firstly, let's start with assets. All assets have what we call debit balance. It means that everything, if being the same, assets balance brought down will always be on the debit side. It will always be on the debit side. Now, if there's an increase in assets, you will debit such amounts under the asset account. And if there's an increase in the assets, you credit such amounts to the asset account to reduce the what? The balance on the debit side. I'll repeat that again. Asset accounts. Whenever there's an increase in assets, you purchase an asset or you reevaluate an asset, it will be on the debit side of the asset account, irrespective of the assets, either current or not current assets. But whenever there's a deduction, it will be on the credit side of the assets. Liability. Liability have credit balance. Liability have credit balance. Now, it means that whenever there's an increase in liability, it will be credited to the liability account. And whenever there's a reduction in the liability, it will be debited to the liability account. Revenue. Revenue have credit balance as well. It means that an increase in revenue will always be on the credit side. A reduction in the revenue will be on the debit side. The next one is expenses. Expenses have debit balance. Expenses have debit balance. This means that an increase in expenses will be debited, while a reduction in expenses will be credited. I hope I'm making sense. Then after that, we move on to the equity. Equity have what we call the credit balance. So whenever there's an increase in the credit balance, it is to be credited. Whenever there's a decrease in the equity, it will be debited. So reduction on equity is debited, while the increase in the equity is credited. Okay. That being said, the next one is that, okay, I think I've explained that about that. So before we move into the question, I want to know if you have any question for what I've explained so far, please ask your question now. Because this foundation that I've set is actually very, very important for you to grab. And this law that I've given you is what is used to prepare ledger, to post into ledger, and used to prepare trial balance. Is what is used to prepare ledger and used to prepare trial balance. So let me give you a minute to. If you have any question, you ask me. If there's no question, I will continue the class. Okay. So in the absence of any question now, let's move to question one. Let's move to question one. Question one is a question that is used to test. Sorry, before I move on to question one, I beg of you, everything that we do in this class, please take it very, very seriously, because because the exam is just few weeks to come. So you need to take it very, very serious. And this is a question that the examiner loves to test, because this is foundation. They call it foundation because try as much as possible to test the basic things that you expect to know that you can build on skills. And this double entry principle, is actually what they test. Almost direct, indirect out, they find a way to test it. So you must be well grounded in it. Now, the first one, the question one, testing about journal. Remember I said under the accounting process that the first thing is to what? The first thing is to record and analyze financial transaction. That's the first thing, right? Now, the second thing is actually what? Posting into journals. Now let's look at how journals look like. And this is now question one. Question one says, post all transactions to journal. We are expected to post all the transactions into journal. And what I want to say, I say journal are prime books of account. They are the what? They are the primary books of account. It means that the sources, the documents that we have are used to prepare what this straight up. Okay. Now let's move on to this. So we have number one says that July 1st, Adeyemi introduced 3,000 cash as capital. I will advise you not to look at the solution and listen to my explanation, because the solution will always be with you, but my explanation might not also always be there. Okay. July 1st, Adeyemi introduced 30,000 cash as capital. What are we referring to here? What we're referring to is that they're starting up a business and they have brought money as in form of capital and introduce it to the business. You have to ask yourself a particular question. Who is the receiver and who is the giver? Because every transaction must have a double posting. Every transaction must have double posting. So two accounts are always involved in what? In a transaction. Minimum of two accounts are always involved in a transaction. Now, given this, now ask yourself a question. Who is collecting? Who is receiving? Sorry, who is receiving? Who is giving? If you introduce 30,000 cash as capital, then capital is the one what's giving out. And who is receiving? Your cash account is the one receiving, because if you give out cash should be the one to receive. So your cash is the receiver, while your capital is the giver. So the two accounts involved there are cash and capital, and the receiver is the cash, while the giver is the capital. So whenever you are preparing your journal entry, the standard says that the debit entry transaction, the double entry account will come up first. The double entry transaction will come out first. Okay? So that's why about that. So, okay. So, the cash account is receiving 30,000. So we have it here. Cash account, can you see it here? We have it to be what? 30,000. Then the other account that is what? Is giving is capital account, and we have the crediting is as 30,000. And every journal, I've seen an example before in your past question that it was said that that there's no need for what's called narration. But if they are silent on that, you're expected to give narration. Narration is not a big deal. Narration, put the narration there as your English word. It's not compulsory for you to cram any narration, okay? So for this one, I put the narration here is being capital introduced to the business. Just simple narration. The purpose for the narration is that anytime I come back to the details, if I say cash account, capital account, I say, okay, what are they doing for? Are they paying out or what? But that narration alone will help me to know that it is what? It's cash being introduced to the business. So it allows me to identify things on time. Then we have July. So we are done with July 1st. The second one where we have July 2nd, which is Adeyemi borrows 40,000 to purchase a van. He borrows how much? 40,000 to purchase a van. Now, two accounts are what I've initially involved. If I ask you for that question, what do you do? Okay, he borrowed. If he borrowed something, okay, then there are two accounts will be involved. Loan accounts. There will be loan accounts because when you borrow, that means that you have given a raise to what loan. So we have loan accounts. We now have, if you borrow, so when you borrow, they pay the amount, that money into a particular place, isn't it? Where they pay the money to? Into a cash account or bank account. It depends on the one you want to use, okay? They pay it into what? Bank account or cash account. If you are using two-column cash book, it can what? Include say cash account because the second column, which is bank column, we cover all for it. So if you are using cash account, it can be rather as what two-column cash book. That's what they're calling it cash account. So it means that the initial transaction will occur within these two people before they purchase van at all. So they go to number one, since they didn't tell us that the money was transferred straight to the van vendor. So firstly, the loan account and the cash account are involved. So you ask yourself, who is receiving, who is giving? The receiver here is the cash account because it's the money that is coming in. And remember, I said that asset account are debit entry. They have debit entry. I remember as well, I said whenever there's an increase in an asset, because they have debit entry, then you must what? You will debit the increase to that account. But whenever there's a reduction, which means if they are giving, you do what? You credit it. So cash account is an example of current asset account. So it means that it's an asset account. So when it's receiving, it means it's increasing. You debit it. That's another logic for you to know. And who is giving? Loan accounts. No account is giving, so we credit loan account. And loan account is giving is an example of what? Current liability. It can be current or long-term liability. It depends on the agreement on the loan. Okay, so we call it what? Let's call it liability. And I said that liability are credit what? Entry. And whenever there's an increase in credit entry, what do? You credit it. Because whenever there's an increase in liability, what do? You credit it. And that is what is playing out here. So the initial two accounts are cash, number one, and what? And loan account. And cash account is receiving, is increasing. So we debited it. And while loan account is what is giving, so we credited it with the amount. And we have the narration to do what? Being amount borrowed for capital purpose. We call it capital purpose because it's what? It's for van and it's for long current assets. Now that we have this money in our care, what do we use the money for? We now transfer the money from our what? From our cash account to the what? To purchase van. So which means that the cash now is giving while the purchase account is now, the cash account is giving while the van account is now receiving. So which means it's an asset. When you purchase an asset, you're adding maybe if we have two cars before, you have bought to another one, you add it to it, it's worth to what? 3. And I said, whenever there's an increase in an asset, what do? You debit it. So which means that the movement will now be motor vehicle. The second movement will be motor vehicle and cash account. So motor vehicle is the one that is receiving it. It's an increase. So we have a 40 here. And while cash account is one giving, we have 40,000 here. And what is it? It's a being amount used for purchase of van. Being amount used for the purchase of van. Okay. After that being said, The next one I want us to look at is the July 3rd. It says, Adeyemi buys inventory for 18,000 on credit. He purchased goods on what? On credit, isn't it? Now, good. If that's the case, inventory is what? Which element does inventory belong to? So answer the question. Current asset. Correct. Correct asset. So inventory is what example of correct asset? And we have the other leg to be what? Purchase on credit. If purchase on credit. Okay? Now the two accounts involved here is purchase account and no, it's on credit. Purchase account and trade payable accounts. Now if you ask me, why are we not using inventory accounts? Why are we using purchase accounts? Now, we are using purchase accounts because under IAS 2 inventory, there are two ways in which we calculate or we prepare or we account for our inventory. We are still going to take that. So let me just chip in so that you get the clarification. We have what we call the perpetual and we have the periodic method. When you use the word perpetual, it means that when you use the word perpetual, what this means is that transaction, when you have your inventory, there will not be movement of inventory on the account until the end of the financial year, where inventory audit will now be carried out. Okay? But when you use the periodic, periodic audits, there will not be movement of inventory on the account until the end of the year. But perpetual means there will be movement. So under the perpetual account, we use what? Purchase account. Purchase account are being used for perpetual. But under periodic, we use inventory account. So basically, we normally use what? Perpetual. So if you see inventory purchase, we normally refer, if we see inventory purchase, we regard it to under purchase account, which means every transaction in inventory, whenever you purchase, you sold, and everything will be regarded under what? When you return, rather, when you purchase and you return the purchase, everything will be captured under the what? The purchase account. So that's why we have the purchase account and not inventory account, okay? So we have the purchase accounts. Purchase account is receiving. Why is it receiving? It's an increase. It's an expense account. It's an expenses account. An expense account is what? It increases over, whenever it increases, is you debit it. So that's why we have it what? Purchase account and trade payable account. Trade payable account is liability. And as I said, the old name given to this trade payable is creditors. Creditors are those that supply us goods on credit, which means they don't collect money as at when it is needed, as at when we collect the goods rather. Okay, so what we do is we debit the purchase account and we credit trade payables account. Then the next one that we have is the July 5th, which is Adeyemi pays his supplier 10,000 naira. Now this pay his supplier 10,000 naira is as a result of what? He paid his supplier 10,000 naira, which means number one, his supplier means the creditors, the trade payables that have collected 18,000. Now he's paying 10,000 out of it. We need to reduce it. So who is receiving? The trade payables is receiving. Who is giving out? Cash is giving out because our cash is reducing. And once our cash is reducing, you credit it. And trade payable is what? Trade payable also is reducing. And once your liability is reducing, what do? You debit it. So two of them are reducing. So this transaction is what? Is debit the trade payable account and credit the what? Cash account. Then another one that we have is Adeyemi says, so we have this also. Adeyemi says inventory for 12,000 cash. Adeyemi says inventory for 12,000 cash. So for these two are involved. When you make sales, it's on cash. Your cash is what? You'll be happy. Your cash will receive the amount. Your sales will be what? Will be the one to give it out. So you have 12,000 and you have what? So we have the 12,000. You credit cash account with 12,000. Then you So you debit cash account with 12,000, then you credit sales account with 12,000. And that's being cash or what? Being cash sales to customer. That would be the being cash sales to customer. That would be being cash sales to customer. So let's see. Where are we right now? Okay, we are on July 7. Say that Adeyemi says inventory for 9,000 on credit. Now, he sold on credit. Since you have sold on credit now, two things are involved here. It means that what? Sales account is involved, at the same time also trade receivables is involved, because the cash is not involved here because it was sold on credit. So your sales account, your revenue or sales account will be involved, and also your what? Your trade receivable will be involved. Now, which one is receiving? Which one is increasing? Your trade receivable is increasing. Now you debit your trade receivables. Then you credit your what? You credit your sales as well, because your sales also is increasing and your sales is your revenue. So you credit it as well. Now, lastly, the one we have here is July 10. Adeyemi received 8,000 naira of the money owed to him by the customer. So Adeyemi received 8,000 naira of the money owed to him by the customer. Now, owed to him by the customer, that's trade receivables. It means that a transaction has occurred in the past that will lead to an inflow to Adeyemi, and that is what we call to as well trade receivables. So it means that two accounts are involved here. Your cash will be the one to receive the money. And what? Your cash increases, isn't it? So you debit your cash account. Then your trade receivables is reducing. And when your asset is reducing, what do? You credit such accounts. So it means that what? You debit your cash account and you what? Credit your trade receivables account. So let's say, can you see that here? And that will now being cash received from customer. Being cash received from customer. So this is actually journals. What we have done so far is journal, because you can, if I one thing about journal is, if I want to pick the total cash I spent for the year, I can't pick it for the month. If I want to know the balance for the month, I can't know it in my journal, because it only represents or show transaction as they occur separately. But when you are done with your journal, the next thing is now for you to move into your ledger. And ledger is what we call the permanent books of accounts. They are the king's book. It means that what you have posted there are expected to come and stay. And you are posting from the what? From your journal. You are using source document to post into your journal. We are now using your journal information to post into your ledger. Now, journal also are useful for to raise correction on your financial statement. They're also useful to bring in transaction that does not actually involve movement of cash, depreciation, amortization, gain, and the likes. Okay. Now that we are done with journal, the next thing now for us to move into ledger, because based on our accounting process, it says that analyze and record and analyze financial transaction, post it into journals, and post it into ledger. So let's post into ledger. What you just need to do, if we are able to do your journal very well, you have no issue. You just pick the respective accounts and post it there. So let's look at the first one. Say that, so we are repeating the same scenario. We are using the same scenario now to answer question 2. Okay, so I just repeated it here so that you have to see it clearly. So, because the reason I'm doing this way is we are building a foundation that we are going to build on. We are constructing a foundation and want it to be strong enough that when we build on it, we will have a strong and a better building. Okay. Now, July 1st, Adeyemi introduced 30,000 cash as capital. This is what we have analyzed before. Okay. So this is what we do. You know that two accounts are involved, right? cash account are involved, number one. Number two, which account also is involved. Cash account involved, yes. Cash account is involved, number one. Number two, this capital account also is involved. So we have two accounts involved. So we come back, so we have the, can you see here, we have the capital, this capital account is a ledger on its own. So we have, what is the format? We have two sides. We have the debit side and we have the credit side. Debit side, we have the credit side. So we have two sides on the ledger. So, and these are the information that we have here. We have the dates, we have the particulars, we have the journal folio, and we have the amounts. The journal folio means what you have used to enter it here. The information I use the journal here, the journal folio is what we are going to be here so that you can easily link it together. And the journal folio as well can also be your what? Your PV, your voucher number, so that you can be able to trace it. Okay? Now, after that being said, we now go to Adeyemi, introduce 30,000. Debit it, can be credit it. We have, can you see here? We have it. July 1st, cash, 30,000. So we are crediting the account. Once you credit the account, you now move on. You move on to cash account. You open cash account. If cash account is not existing before, you open cash account. So you move on to cash accounts. I'll just show you this once so that we won't waste too much time on it. You open cash account. Can you see it here? Where is it? Where is it? Where is it? Where is it? Okay, can you see July 1st, capital, 30,000. Now, if you notice it, under particulars, we are using the name of the other account where you can find the second leg. The reason why we normally use it is because we'll be able to, it will be very easy for us when we are doing audits or when you want to trace it. If you have any differences, we are trying to reconcile it. It may be very easy for you to trace the second leg. So the particulars there is actually what in regards to how the accounts, the initial account that you have actually what that you have actually called. So under my cash account now, I have capital. July 1st, under my particulars, I have capital. It means that if I go to capital account, I must see the cash under the credit side of capital account. And that is what we're going to find here. Can you see it? Cash here. That's what you can find here, 30,000. And the same thing goes for the rest of the transaction. So I'll just go through it, run through it again. So we have this 90. Now, this is here. We said that what? Four transaction, what four accounts are responsible to. We have first one is when we collected the money. The second one is when you pay out the money to purchase the van. So we have the loan account. So we have the first one is the cash and loan account. The loan account is the credit, is the liability. So we have it here. Can you see July? So we put it July's cash, 40,000. If you look at your cash account, it will note you see under cash account on debit side, you're going to see July 2nd loan. How much? 40,000. It means that we are receiving it, but that money is as a form of loan that we have collected. Then the second one will now goes to where? We now goes to our van, which means we now go to van, which means we need to what? Increase our van, and we purchase by July 2 cash 40,000. If you look at your cash account, you're going to find July 2nd motor van 40,000 on the credit session. On the credit session. I don't want to be going scroll up and down, so you have the solution with you. So I believe we can go up and down to confirm that. Then the last one we have is Adeyemi buys inventory for 18,000 on credit. And we said that two accounts are involved here when you did the journal. That the two accounts that are involved here is what is the purchase account and trade payable account. So we need to open the two accounts. So we open the two accounts here, we have it here. So we have the two accounts, can you see, purchase account, and we have the trade payable account. So anything that regards to trade payable account will be found under this account. Anything that regards to purchase account will be found under this account. That's how it works. That's the beauty about what? About ledgers. It means that at a particular point in time, I can ascertain the balance of each account. And I can easily know to my transaction on each account. If I have trade payables, the name of people I have purchased from, I can easily see it there. Because if I put purchase, Number one, after purchase hyphen Ayomi, purchase hyphen Mullet, purchase hyphen Salu, purchase. So like if I say purchase there with the name, it means that these are the people that I purchased the item from. Okay. After that being said, the next one is for us to now move to the other aspect. The other aspect talks about the Adeyemi pays a supplier 10,000 naira. Adeyemi pays supplier. So Adeyemi what? Adeyemi pays the supplier 10,000 naira. So two accounts are involved here. It means that the trade payables account are involved, like I said, and the second leg we go to where? We go to the cash. It's cash that is given. So you just find. So when you are doing that, when you are done with the posting from one place to another, the next thing that you need to now know is to now close it. Close your account. How do you close your account? And that's what we call the balance carried down, BCD, balance carried down. Now, if you look at this, I'll just explain this. If you look at the capital account here, the only transaction that we have here is on this side. If you prepare it yourself, we're going to have this only this figure on this side. Are you with me? So now, at the end of the day, you need to close it up on a monthly or weekly basis based on your organization. Now, if you want to close this down on a monthly basis, that's okay, fine. There's no figure on this debit side, but we have figure on the credit side. So it means that our balance carried down will now be brought to the debit side, and the balancing figure, which means the balancing figure on the right hand side must be seen at the left hand side. So we bring the 30,000 naira here. So we add 30,000 plus 30,000, we give us 30,000. 30,000 here will give us 30,000 here. It means that both sides now have balance. So we have our balance carried down to be 30,000. So following month now, in the month of August, at my opening balance, I will now put August 1 on the credit side. I will now put balance brought down, which means that in the month of August, the balance I'm going to start with is what? Is 30,000. The balance I'm going to start with is 30,000. Now, let me also use this cash. Let me use cash account to explain. Now, if you look at cash account to explain now, for year we have this figure. We have a total amount. Okay. We have 30 on the credit side. We have 30,000, 40,000, 12,000, 8,000. Now, if we add everything together here, it will give us a total sum of 40, 70, 20. Oh, this is a mistake here. The total here, if you had the debit side together, 30 plus 40 is 70. This is plus this 20 plus 70, that's 90. This is expected to be 90,000, not 40,000. This total should be what? It should be 90,000, not 40,000. Now, if you come to the other side here, if we add this van is 40,000, trade payable is 10,000. And now van for plus trade payable, you give us 50,000. Now, what we have on the debit side is what? It's 19,000. And on the right hand side, we have 50,000. So we need that what? We need a total of 40,000 now to balance it. So 90,000 minus 50,000 will give us 40,000. And that will give us what? 40,000 will now be our balance carried down. It means that at the end of July, the total cash that we have with us is 40,000. That's what the meaning of this balance means. It means that the amount that we have with us as regards to cash is 40,000. Is 40,000. So after that being said, I will wait for a minute to 2 minutes to ask to see if you have any question on the question 2 that we have solved. I will ask a question or 2 minutes. If we Okay. So in time, so since there is no question for solution 2, let's move to question solution 3. Let's move to question 3 rather. Now, question 3 says, you are required to open amend books by means of journal. Enter the following transaction and extract a trial balance. Now, this comprises of 3 accounting process. It comprises of number 1, it comprises of the journal. Number 2, it comprises of ledger. Number 3, it comprises of trial balance. Okay. Now, what are ledgers? Ledgers are actually what? Journals, like I explained, they are primary books of accounts. They are accounts in which source documents are used to prepare for. And also, we have types of journals. We have sales journal or sales day book. We have purchase journal. We have return inward, return outward. We have cash account journal. We have another journal. We have general journal. Now, whenever we have sales on credit, it's being recorded into journal. Whenever we have purchase on credit, it's being recorded into journal. Return inward is also recorded to a journal. Return outward also is being recorded to a journal. So at the end of the day, we will now add everything. Says the book, right? It also says the book. So at the end of the day, we now add everything together and post them to the respective accounts. I'll post them to the respective accounts. So as we solve this question, you understand better what I explained. So let's read question 3. Ahmed financial position as at 1st August 2014 was as follows. Cash in hand, 6,300. Cash at bank, 24,000. Stock, 3,600. You are required to open and amend books by means of journal. Enter the following transaction and extract a trial balance. Then I give us August figure. They give us from August 2nd to August 31st. So then let's open what we call general journal. General journal is help us to get our balance, our opening balance for this year. Okay, so let's look at this here. We have cash in hand to be 6,000. So the first thing is open what we call the general journal. Can you see it here? General journal. So we have the cash in hand. We have the cash in hand. We have the cash. Let's see there. Oh, sorry. So we have the cash in hand. We have cash at bank. We have stock. Now, adding all this together, will give us the opening balance. It will give us the opening balance for August 2014. You give us the opening balance for August 2014. Okay. Now, the opening balance, I'm going to tell you where it is needed. So now let's move to the other transaction. We have August 2nd, purchase goods in cash. Now, if we purchase goods in cash, 2 accounts are involved here. 2 accounts are involved there is the what? Is the purchase account and the cash account. The purchase account and the cash account. So let's look at it. Let me show you. So we have the balance. We have the balance brought down here, 6,300. The cash, that's cash account. We have it to be 6,300. The balance brought down. We have the purchases to be 4,000. Now the purchase will be on the credit side because cash is given. So we credit the giver, and who is receiving? The purchase account is receiving. So we come down here. So let me paint this. Okay, I think I want to do something. Every figure I've talked about, I'll be painting it now so that you will understand the one we have used and the one we have not used. Okay. So this one is the opening balance. given to us in the question. And the second one says that this opening balance given to us a question. And the second one says that we purchase a multi-event, and when you purchase the multi-event, what happened to it? It means that our what's called our cash is given, so our cash will be credited, while our van okay, purchases, okay, purchases account, can you see purchase account 4,000 will be debited. Purchase account 4,000 to be will be debited. So okay, it's goods, not van. Purchase goods in cash. Purchase goods in cash. So we have the purchase account will be is receiving, is an expense account, it will be debited. While goods will be what? Will be credit. So it's cash will be credited. So the one that we have next is bought goods for comma on what? On credit. So they bought goods on comma on credit, 17,500. So accounts are involved there. We have the trade payables account is involved, and we have other accounts is involved. Bought goods, okay. Purchase also is involved, which is 17,500. Now this time around, because it's on credit, it's not going to be under our purchase, but it's going to be under our purchase sales book. It will be under our purchase sales book. So if you look at it here, journal, can you see purchase journal? Can you see the amount here? So we have it here. So this one, this is it. So we have it. The reason why we are putting it under the purchase journal is because we want to add everything together. When we add everything together, is the figure that will now be taken to our purchase account as sundry. Is the credit figure, add the addition of all the credit figure together in a month that will be taken to our respective account and be tagged the name sundry there. That's SUNDRY. Okay. So we have that 7,500. Then we will look at the trade payable. If we were to trade payable, okay, comma, okay, yes, comma. This is what trade payable, but we have the what? Where is it? That's not it. That's not it. Okay, this is it. So we have this trade payable. Also, we have comma. And that's what, as a result of, because E is a liability, is a liability, it have the other part of it to be credited, which is 17,500. So at the end of the day, I will now add everything together to what? I'll now transfer to my purchase account. That's why I'm having purchase account here. It means that the second level should be found under what? Purchase account. It means this purchase journal is not actually what part of the double entry as regards to the ledger. But we are keeping it, we are actually opening it down so that we want to add everyone together so that because if we are keeping it inside our purchase account, ledger, it will be too much of information can actually distort or can disturb people using the ledger balance. So that's why we normally put it under journal. Then after that, we pick it from journal, we take it to the respective account. So for this account, since we don't have any other purchases inside this account, what we now do, so it means that we cannot take this 17,500 to the purchase account. So let's look at purchase accounts. Purchase accounts. Can you see it here? Sundry account is the last figure. There is the last figure here. Sundry account. How much? 17,500. It's always the last figure because it's the addition of what? It's the addition of a figure from the purchase journal. It's the addition of a figure from the purchase journal. So let's look at the other one that we have here is what? The other one that we have here says that bought shop fittings and paid by cash. So they bought shop fittings and paid by cash. So two things are involved here. Since they pay by cash account will be affected, and the fittings account also will be what? Will be affected. Now, shop fittings account is increasing. Why the what? Why the bank account? Because it's check. So we are talking about bank this time around. So why the bank account is what is giving. So bank account is reducing. We are going to debit or credit the bank account because it's giving. Then we are going to credit what? The We're going to credit the bank account because it's giving it. We're going to debit shop fitting because it's one receiving it. So let's look at how it's being solved here. So we have the what shop fitting is the one receiving it. So we have the formation here 2,400. Can you see? Is one receiving it 2,400. Now, if you go to bank account, this is our opening figure. Give it to us in the question 24,000. And then we have fittings. Can you see shop fittings is reducing it? Is that why we have it on the what? On the credit side. So we have it on the credit side because what is because it is reducing it. Okay. Now, after that has been set, so let's move on back to a question. Let's see. Another one that we have here is what is cash sales. Now, cash sales actually talking about the word cash sales. It means that they make sales and they collected cash. Cash will increase, so we credit cash, and what? Sales will increase, so we credit cash. Cash will increase, so we debit it because it's an asset. So we debit cash while we credit sales. So if we look at it here, can you see it here? We have sales of 28. We have it here 28. So if we look at sales account, we are going to see the other leg on the credit side of sales account. So let's look at sales accounts. Can you see it? Credit side, that's 28. Can you see? So that's the way we are posting it. We put it, we look at it, we post it, we look at it, we post it. Okay. Now let's move on. So the next one that we have is on August 12th, sold goods to Kasumu on credit. So this one is sold goods to Kasumu on credit. So two things are involved here. The sales day book or sales or journal will be affected because it's on credit. It will be affected because it's on credit. So we have it there. At the same time, also sold goods to Kasumu on credit. Then the other aspect will now be what? Will be on the Kasumo. Kasumo will not be an example of a customer under trade receivables. It will be found under the trade receivables. So let's see that the customer account will be debited. Why the sales is expected to be credited, but this time around I'm going to post it under the journal now. So after we have added if we have any other credit item, they will now add everything together and transpose or transfer into the sales account and transfer into the sales account. So let's look at the two accounts here that we talked about. So if we look at the solution here, can you see here, we have it on the 12th of August. We have it to be worked under the sales journal. And the second layer, we go to other Kasumu. Can you see, and Kasumu is what? It's trade receivables accounts. So it will be under, so we have it here. Can you see that? We have it here. So we are able to keep our record appropriately up to what? August 12th. Then the one is not that paid comma by check on account. So they are paying this comma by check on account. So if they are paying by check, two things are involved here. It means that comma account will be what? Comma account will be if you are paying by check, it means your bank account will be credited. Comma account is one receiving, it will be what? Debited. It's as a result of what? Liability, reduction in the liability. As a result of reduction in the liability. So let's look at that. So can you see that here? We have it here, bank 10,000. That's the amount that we pay. If you look at the bank account now, you find the second leg on the credit side. Can you see that here? So the rule of double entries appears. Every transaction I expect to be entered twice. Every transaction I expect to be entered twice. So after that, also we have cash sale. The way we treated the initial cash sale is where we're going to treat it as well. Cash is what? Receiving. So it's increasing. So we debit it. Why sales also is increasing. So we what? We credit it with 4,700. So let's look at where it has been done. Yeah. Can you see that? We have it here. Cash sales. That's 4,700. And why we have it under sales? Because it's cash sales. It's not going to be under our sales journal, but it's going to be under our what? Sales account. How much? 47. We have it here. That's why we have the 47 in our solution. So excuse me, let me take some water. Thank you. So the next one we move on. So let's move. We stop at August 18. Okay, let's move on. We have August 19. That's who says paid cash into bank. So paid cash into bank. What are the plans? So we pay cash into bank. That's contra entry. Contra entry actually is an entry that is actually a transaction that appears on the both side of an account. That's contra entry. An item that appears on the both side of the account. So when you pay, if you are using 2 column cash book, if you pay money to the bank, it means it's going to appear on your debit side. At the same time, it's going to appear on your credit side. So this time around, they're saying pay cash into bank, but because we are keeping the two, so we can easily identify them. So pay cash into the bank. Who is giving? Cash is reducing because we are taking out of the one that we have. We are paying to the bank. So cash is what? Is reducing, while bank is one increasing. So we are what? We are going to debit bank account because it's receiving, it's increasing. Then we credit what? Cash account. So if you look at the cash account now, can you see? Can you see we have C there? The C here means contra entry. Contra entry. Now, after we have, then we have to go to the bank account as well and post it under it as well. So you post it under the under it as well. So it means that you have been able and successfully entered that transaction or posted. We post, so we have been able to post that transaction into it. Next one is paid carriage in cash. Now, paid carriage in cash is 200. Carriage is as a what? Is the amount that we use to, carriage is means of bringing in goods. You can be bringing in goods or taking goods out. That's carriage. Like if you go to the market and probably you have some people that want to carry you. So the amount that you pay to them is actually what you got as well carriage. When you get to the financial statement, you will see the difference between the carriage inward and carriage outward. So for this one, we have what we call paid carriage in cash of 200. So carriage is one receiving is an expenses. So we debit it. The cash is given, and what you should credit cash. So let's see. Okay, let's go. So we have that. Can you see we have that to be carriage to be 200, and we now go to carriage. So let's look for carriage. Cash 200. So we have done that. So let's go back. I think we are making progress. The other one we have is what? 23rd. We have 23rd. Bought goods from Mountain in cash. So they bought goods. So if they bought goods, two things are involved here. Cash is given, so cash is reducing, and we purchase it for what? For Mountain also. So Mountain also we increase by 640. So we look at it under purchase 640. Let's look at this. Purchases. Can you see cash 640? Can you see cash 640? Then we have cash is one given, so we have that to also be 640. Cash is one given, so we have that to be 640. Then after that, what is we have? We have bought goods. Sorry, we have sold on August 27 now. We have sold to Kenneth on credit. So sold to Kenneth on credit. Two things are involved as well. So it means that it's going to affect our sales journal. So it says on credit. So it's going to affect our sales book. At the same time, also the second leg, we now go to where second leg, the everything is still going to sales account, but we just want to add everything together. Then the other one, we now go to where our Kenneth, and Kenneth will fall under the trade receivables. Kenneth will fall under trade receivables. So which means we are going to debit Kenneth with 1,300. So let's look at this one. Can you see Kenneth 2713? Says 13. Now, if you look at that, let's go back to sales journal. Now it says journal, we are done with the entry, okay? But if the exam, if you are working in, there's no need for you to you still leave it open. But this one, we know that we have done with this entry, and the total year is what 2,150. And this 2,150 is sundry amount that will be taken to the credit section of the sales account. So if you look at the sales account here, can you see it here? We have what? We have sundry of what? Of 2,150. and that can be found under the credit side. So it is addition of the sales journal that is brought under our sales account on the credit side. Now, after that being said, the next thing for us is not to move into what we call the bought new bicycle and paid by check. So if we are paying by check, it means that bank is involved here. So bought new bicycle and paid by check, 4,000. So bought new bicycle, so bicycle account is receiving while bank is giving. So let's look at bank account comes first. So we have that to be bicycle, which is what we credit it because it's giving, it's reducing. Then we go to the other one, which is the bicycle account. What do we do there? Is receiving, so we debit the account. Can you see? That's why we debit the account. We debit the account. So if you debit the account, then what is an asset? It's receiving, it's increasing. So you debit it, so you debit the account. Then another one what we have here is paid rent of premises by check. So the pay rent of what by check or 2.5. So which means bank is giving out by is giving out to rent, which is 2.5. Bank is giving out to rent, which is 2.5. So we have that, so it's given to us to 2.5. Then another one, second one now comes to the bank, sorry, to the rent, rather. You have the rent. So we have the rent to be, can you see? Rent is an expense account. Rent is an expense account, so it always have what debit entry. Debit entry. Now that we have posted all this, the next thing for us now to what? Now to close our account. So let's close our account. Let's close our account. Let's see. So capital. Now, okay, we have not talked about capital. Now, capital account is we need to know the balancing of what of the we need to know the capital. And like I said, capital is what the capital also is found under the equity. So is the net residual interest on what on the assets. So it means that the total asset that is available for you at the beginning of the year, the net asset that is available for you at the beginning of the month, will be your opening balance for capital. So if there's an other one added to it, it will be what it will be stated there. So in this one, we have cash in hand, we have cash in hand and cash stock. So what? Because it's stated here, if you look at the solution here, so if you look at the question here, it said that what I made financial position as that, which means that I've not carried out any, before I carried out any transaction in the month of August, the opening balance is this. So adding everything together will give me my total capital account. Give my total capital account. So, and that will be that the result of what we have here. So we have that to be the addition of these things together, we give us 3,900, and that's our capital account. So that is the result. I brought it down here. Balance brought down. Is balance brought down? Balance brought down. If we are starting a new month, we have balance brought down. If we are starting a new year, you have balance brought forward. So balance brought down is 3,900. Now, I think we are done with all postings. The next is for us now to close our ledger. The next is for us to close our ledger. So how do we close our ledger? We just look at it one side against the another side. One side against another side. Now, if you look at our capital account here now, we have this to be what? 33,900 is on the I side, on the credit side. But on the debit side, we don't have any. So it means that what is 0 minus 33,900 minus 0, we give us 33,900. So we put what? 31st 8, that's the last day in the month of August. Balance carried down, or what? 33,900. Balance carried down of 33,900. So after we have that, the next thing for us to now move on to what? The balance brought down, which means this will be the opening balance for the next month. And the next month is September. So this balance brought down, it means that we have closed for August. Then this one would have if the 1st of September 2014. So it means that the opening balance for September as regards to capital account is 33,900. So if we go the same thing also for this cash account as well, this is 6,300 plus 28 plus 47 will give us 13,800. Now, if we add this one I've painted yellow, the 4 ones under the cash account, where the 4,000 plus 8,000 plus 2,000, that will give us 5,000 plus 640, that's 5,640. Now 5,640 is lower to 13,800. So it means that our balance carried down will be on the credit side. So 13,800 minus 5,640 will give us this figure that we stated here, 8,160. Now this 8,160 is what we regard to as the balance carried down. It's balance carried down. So the addition of it will be here. Now, if the beauty of this is this, it means that this is the amount that is left for you. So it will be what? It will be your opening balance in the month of September. That's why we have it here. Opening balance. Can you see? 1st of what, September 2014, balance brought down. Balance brought down is what? It means that this is the opening balance for this period. Okay. Now the same thing also have to come as well. Coming also have what? Balance carried down. We have balance carried down of what? We have balance carried down of what we call the what? 7,500. Now 7,500 is the balance carried down given. Balance carried down. How do we get 7,500? It's 17,000 minus 10,000. 17,000 minus 10,000 give us 7,500. This 7,500 is what we call the amount that we are still owing. What comma is what is under our trade payable. So this 7,500 is because we purchased 17,500. We have paid 10,000. So the amount that we are still owing as what is 7,500. So that's why we have it there. Balance brought down is 7,500. So this is the pending liabilities that we have as regards to comma. So another one also that we have here is what we call the short fitting. Now, short fitting is that what is an asset. So what we do is we close it up. We close it up, and after we close it up, the next thing now is for us to happen what? September, which means our opening balance is 2,400. When you add up to it, it will increase to 2,400 because we are going to debit it on the short fittings account. Okay, then another one also I want to explain is also the bank. The same thing also applies to the bank. 24,000 on the debit side, 24,000 plus 8,000 will give us 24,800, and which is higher. And it is higher than what? It's higher than the other side. Now, what is the other side giving for? It's giving us 2,400, 10,000, 4,000, 2,500. Add them everything together, it will give us a total sum of 10, 4, 6, 3, 4, 5, 6, 7, 8, 18,500. Now, 18,500 minus 24,800 should give us 5,900. And that is our what? Our balance carried down. That's our balance carried down. Our balance carried down for the month will not be our balance brought down for next month. Balance carried down for this month will be our balance brought down for next month. So after that, also you do the same thing as well across the board. When you're able to do the same thing across the board, then I believe you are good to go. So after you have done that, then we now do trial balance. So you close the rest as well. That's what we are doing. So what we have been doing is closing up the account. Closing up the account. Now, after we have closed up the account, the next thing, the question says that we should prepare trial balance. And I said that trial balance have what? Trial balance is a statement used to test the accuracy of the ledger. It is a statement used to test the accuracy of the ledger. It is a statement where all balanced ledger can be found. All balanced ledger can be found. Now, let's see how true the definition is. So let's look, if we look at the first one that we have there, we have capital, isn't it? We have capital account. No, if we look at here, I want to start with here. Can you see? We have a capital account. That was the first one that we have here. Now, this capital account, if you look at it here, the balance border is other way, under the credit side. So this balance, this amount under the credit side is what we are going to see under our trial balance. Our trial balance will go in line with this balance brought down. Our trial balance will go in line with what? With the balance brought down. Now the balance brought down here is what? Is 33,900. 33,900. So if you look at the trial balance here, if you look at the trial balance that we have here, can you see capital? Can you see it's on the what? It's on the credit side. It's on the credit side. So 32,900 is on the credit side. So every balancing with regards to this Now, if you look, don't let them go too much. Okay. Another one that we have there is the, can you see this rent? Rent, where do we have our balance border? On the what? On the debit side, which is 25. Now, rent and expenses before, even though you without even checking that, we're able to know that it should be on the what? On the debit side. Can you see? Can you see we have it here on the debit side? So let's look at a few more. Then I will explain that. Okay, bicycle as well. The balance brought down is what on the what? Is that assets based on the what? It depends on the policy, accounting policy that they have derived for the organization. So me, I will regard as an asset because it's going to spend more than 1 year, and the benefit will flow definitely flow to the organization. So we have that to be 4,000. So if we look at it here, if we look at it here, if we look at it here, can you say bicycle 4,000? Can you say bicycle? That is the result of 4,000. Can you see 4,000? So it's good to go. Then after that, also let's do Kenneth. Kenneth also is what? Trade receivables. That's on the balance border of 1,300. So we have balance of 1,300. So we come back here. Okay, let's put Kenneth here. Kenneth. Can you see we have Kenneth 1,300. So these are the things. So let me just do the credit side so that you see that as well. Case one is actually what this person coming is trade payable. So it's a liability. It's actually what a creditor. So it's a liability on us. That's why we have 7,500. Now, if you look at it here in our solution, yes also shows it for us. Can you see? Balance border is what is under the what credit side 7,500, which is the amount that we are owing as at that moment. So after that, the next thing for us to now do, so we just do, we can check everything up, and it follows, like I said, when the beginning of the start class, that it follows suit with our what, with the explanation of the rules I've given. That it follows suit with the explanation of the rules I've given, that debit all assets. Number one, after you debit all assets. Number two is that you credit all liabilities. Number three is that you credit all revenue. Number four is you debit all expenses, and number five is what? Your equity are what we call the credit aspect. So which means any equity, example of item under equity, we have the capital, we have the retained earnings, we have the drawings, they are all on the what? On the credit side. Okay, drawings, no, sorry, drawings will be on the debit side. Drawings is already on the, what is what drawings? Drawing is when the owners of the business take out either stock, take out the resources for their personal use. For the personal use, only for the companies to use. So the way I may use the resources is that it can be fund, it can be asset, it can be inventory, it can be a lot of things. That's the reason why I use inventory. So drawing, so anytime the owners of the organization take out a particular item out of what, out of the particular resources out of the organization, is being regarded to as drawing. And there's a linkage, there's a small linkage between the statement of there's a linkage between the statement of financial position and statement of financial performance. The linkage is this: the statement of financial position is all about the contains the assets, the liability, and the equities part, but it's actually have what we call the drawings. And the drawings is like I explained, is where the owners of the business take out of the what business for their personal use. And that link that we have there is actually what is the profit element. You know, the statement of financial performance is for the period. It's for the period. It means the expenses and the revenue that were generated for the period is there. So it's supposed to state the profit or the loss that we have realized for that period. And once you have the statement of when you have that profit or loss for that period, then you have to take that profit or loss down to the financial position, which means and that's another linkage between what, between the financial performance and financial position, is what is the profit element, because every profit or loss there will be taken down to the what, down to the financial position under the equity, So that's a linkage that you need to actually know. And again, for the, and one thing I want to explain also is that for the figures in the statement of financial performance are not carried over to the next year. They are there. So it means that it's for the year. That's why they say statement of financial performance for the year ended
so for the year ended, it means that it's for that year. But if you look at statement of financial position, they say statement of financial position as that means that what is subject to what change. As so date. So it means that what this at this moment, this is what we have, this is our asset. But next year it might be bigger, it might be higher, it might be lower. That's one of the reasons why there's a difference between the way we could do the headings for the statement of financial position and statement of financial performance. So the next one that we have is question 4. Question 4, and that's the cash book. And looking at the time here, I don't think that time will be sufficient for us to attempt question 4. I don't think that time will be sufficient for us to attempt question 4. So probably we'll only solve that in the next class. But before I go for the day, I would like you to ask me question if there's any. I will attempt to. So I'll give like 5 minutes to ask me question. If there's any question that you intend to ask from what we have done, So just give it like a few minutes. Any question? Okay. In the absence of any question, Mr. Emmanuel, I would like to call it a day, and we see in the next class. So from the next class also, we solve this and we move to another question. I believe you enjoy the class. Please, if you do enjoy the class, I won't mind a review from you. You just use the chat button. Just go to the left hand. If you're using your phone, if you look at the right hand side lower, you see the chat button there, so you can easily comment. Okay, no comments. Okay, Mr. Mane, I would like to end the class now. So I wish you best of luck your exam, and at the same time also, I wish you a nice night rest. Thank you for joining me today. We shall meet in the next class. Bye for now.